I'm Greg Hunter. Welcome to USAWatchdog.com. My next guest has his own website, also has 20 years experience in the financial industry. Always an enlightening guest. I'm talking about Craig Hemke of TFMetalsReport.com. Craig Hemke, thank you for joining us today on USAWatchdog.com.
Greg, it's always a pleasure. Nice to visit with you again.
Well, we're out here on Sunday, and last week, I'm reading in the newspaper again, they're with this, could raise the rates in September. We could be raising it in September. And I'm thinking to myself, wouldn't they intentionally crash the market if they raised the rates? Aren't they going to be raising rates into a declining economy by every metric? What do you think handicap for this? Is the Fed just blowing smoke, or are they really trying to, thinking about raising the rates?
They're trying to move things by talking, which is their primary policy. That's why so many of these, we call them Fed goons, not Fed governors. That's why they seem to have such conflicting messages all the time, because they're always trying to get the markets to do what they want them to do. But rational human beings are telling you that they're not going to raise rates in September. Not only are they not going to do it right before an election, that never happens, but additionally, if you look at what we call the rate hike expectations, after yesterday's FOMC minutes were released, the expectations actually went down. There was a supposed 28% likelihood of a rate hike in September before the minutes were released, and now there's a 20% likelihood. And so people see through the nonsense. They know what's going on. And actually, you've got to go all the way out to March of next year. We're talking 7 months from now before you at least have a 50-50 likelihood, Greg, of a rate hike. There's not going to be a rate hike in September. That's not going to happen.
Could we have troubles in Europe? They're very weak. I mean, the European banks, the Deutsche Bank, very weak. Italian banks are very weak. Spanish banks are very weak. They're weak. Could we have some kind of a dislocation effect in September with the banks, or what's your handicap? Could the dollar actually get stronger if these banks get into even more trouble overseas?
Well, this is all part of the paradox of what the Fed's trying to manage. Keep in mind that when the Fed hiked rates back on December the 16th of last year, gold bottomed the very next day in response to that, December the 17th, at $1,050 an ounce. It's done nothing but go up since. So maybe we should be polling, at least at my side, we should be polling for a rate hike. It was good for 30% when it happened. I don't think they can raise rates for a number of reasons, but as you mentioned, the dollar, by raising rates, you strengthen the dollar. By talking about raising rates, you strengthen the dollar, which is sometimes why they don't talk about raising rates, because they think the dollar's gotten too strong. Underlying some of this, though, is the Chinese yuan, which is pegged to the dollar. And the Chinese do not want a strong currency, but as the dollar goes up, the yuan goes up. And part of the calamity in early January, after the Fed hiked rates in late December, was massive devaluations by the People's Bank of China of their currency, the yuan. And that would just happen again. The Fed is trapped, which is why you get this kind of schizophrenic, we're hiking rates, we're not hiking rates. The economy's strong, the economy's not strong. There it is, just getting to be a circus every time a Fed goon speaks. And like I said, rational human beings are starting to see through this, and thus the reaction in the currencies, the bond market, and in gold.
I'm watching the financial reporting, which is, dreadful. It's fantasy land. It's you can't even use it. Anybody would be investing money reading the paper. I mean, they're saying as the economy continues to strengthen, the Fed's case for raising the rate, something to this effect. That's the economy continue. What? I mean, we just had mortgage applications fall off a cliff. I mean, every week it just seems some dreadful metric. I mean, What's up with the economy? If they do raise rates, wouldn't they be, as Peter Schiff said, if they raise rates, it'll be the first time in history they've raised rates into an actual declining economy. Can they do that?
I don't think, I wouldn't argue with Peter. That perfectly sensible thing to say. And again, they're not going to. This is all part of the game that they play. They know that their banks and all of these hedge funds and pension funds and insurance companies and retirement plans are loaded to the gills with low-yielding bonds as they desperately search for yield. High-yield bond funds, things like that have terrible liquidity problems if anybody tries to sell them. Everybody has been driven into all kinds of not only government bonds, corporate bond, high-yield bonds, searching for yield. if the Fed starts raising rates, and if the long bond were to go from 2.25 to 4.25, which is where people thought it was going this year, that would be, let's say, that would have a rather detrimental effect on bond prices, because as rates go up, bonds become at 2%, 1% become less valuable, and the price goes down. The prices go down, net asset values go down of mutual funds, net asset values go down of ETFs, balance sheets of banks, pension funds get squeezed. It would be an absolute disaster. And so this is a game they play, a tightrope they try to walk. And I would, and if I might, just go down a different direction, Greg. Back on, let's make sure I get my days right, a Wednesday of last week, the Fed released what they said were the minutes of the meeting from 3 weeks before. Now, first of all, why this never raises alarm bells with anybody to say, no, wait a second. You're telling me some clerk can't transcribe the minutes of a 2-day meeting in less than 3 weeks' time? Well, that seems kind of odd, doesn't it, when you think about it, Greg?
Yes. You're saying the meetings are phony and doctored.
Or the minutes are.
The minutes are, I should say.
I think what the Fed does is they know how Steve Leisman at CNBC and Bloomberg and the Wall Street Journal all wait breathlessly for their statement at the end of every FOMC meeting. We call it the Fed lines at TF Metals Report. And they all just anxiously, breathlessly report these things as it's the most earth-shattering information ever supplied. And then they wait to see what the market reaction is. 3 weeks later, if the market didn't do what they were expecting it to do or what they wanted it to do, then they release these minutes, which are no more connected to what actually was said at the meeting than, well, than any other connection to reality. I'm lost without a metaphor for once. Look, Greg, this is all manufactured spin and mope, management of perceptions, as Jim Sinclair calls it. The statement comes out 3 weeks later. 3 weeks later, you get these minutes. And the minutes are crafted as a second attempt to get the impact that the Fed wanted. Now, I'll give you this as an example of how you know this is the case. Back in April 27th, an FOMC meeting concluded that everybody thought was going to plow the road, set the table for a June rate hike. And if they don't hike in rates in June, Greg, the Fed's going to lose all credibility, which is what they said again yesterday. But anyway, the market interpreted the statement as dovish. Bonds and gold rallied significantly. The dollar went down. And by the following Monday, we saw what at TF Metals Report we called the May Fed Goon jawboning event begin, where every day it was either Lockhart or Dudley. Sometimes it was Williams out of San Francisco. It didn't matter. Some Fed goon was always out there talking about how the dollar should be going up because interest rates are definitely going to be going up. And lo and behold, on May the 18th, when the minutes were finally released to that April 27th meeting, they didn't match. And all these boobs on financial TV all were scratching their fuzzy little heads going, well, how could this be? This is so different from what the statement said. But nobody ever stopped to then connect the dots and say, well, because it's not. It's not related to what the statement, it's not related to what they're trying to change the message because they didn't get the response they wanted. And now the same thing happened back on Wednesday. Back in late July, that July Fed meeting concluded with no hint of a rate hike coming in September. But yet, they've been running out these Fed goons for the last 3 weeks trying to talk about how, oh no, there should be a live meeting in September. When it was reported on Wednesday, the minutes were said to include notes that all sorts of members of the FOMC wanted to rate hikes in July. They weren't talking about September. Apparently, as the headline said, several members actually, wanted to hike rates 3 weeks ago. Now, if that's the case, Greg, the actual headlines that were released, the statement that was released in late July, on that statement, they always vote whether anybody agrees or disagrees, whether they have their dissent or not. There was one dissent, and it came from Esther George of Kansas City, who has dissented to every statement this year except one. So let me ask you, if there really were 4, 5, 6 FOMC members that wanted to hike rates in July, if really, as it was portrayed yesterday, that Janet Yellen is the only barrier to a rate hike come September, then how in the world did only one member dissent to the statement 3 weeks ago? That's your smoking gun. This is all just a sham. It's a scam. The Fed just puts out whatever they think they need to put out in their desperate attempt to try to manage it all, to try to keep the plate spinning. And nobody ever questions it. It's all taken as a sacrosanct, as if Moses brought it down from Mount Sinai. And I would contend to you it's all BS.
If they don't raise rates, I mean, how long can they cry wolf? And I mean, if they don't raise rates, what happens to gold, corn, silver? What happens?
Somebody's got to call them on it at some point. Like I said, back in June, I mean, go back and anybody can search CNBC's video vault for the reaction to the minutes back in May and to the minutes from the meeting in June. And every single time the bubbleheads on CNBC are talking about, the Fed's going to lose credibility if they don't raise rates next time. Well, that was the same storyline yesterday until somebody actually calls them to the carpet and says, you have no credibility left. We don't believe you. Then they'll keep playing the game. So to answer your question, they'll keep doing whatever they think they need. As long as no one's going to call them on it, they'll just keep lying. That's what liars do.
Do you think the gold market could vault higher on yet another? We're not going to raise rates.
Yes, if anything, one, the loss of confidence and all that stuff, gold portrays that. But look, it is extremely important that people realize this, and I'll state this again because we talked about this a month ago. The price, or what is said to be the price of gold, has nothing to do with gold at all. What is determined is the price of the gold derivative, the futures contract, that trades in New York and trades electronically 23 hours a day. Okay? So if you're that price, that value that you see, is not determined on a day-to-day, intraday basis by fundamentals of gold. It's determined by whether or not the high-frequency trading machines that control every single market these days, whether those machines are buying the paper derivative or selling the paper derivative. That's all that matters. And so then, when you ask me, is gold going higher? Well, then we have to then discern what the key inputs are that drive these decisions by the algo machines, and how those inputs are going to move. Those two key inputs, and anybody can watch this on a daily basis, are the bond market here in the US, whether rates are rising or falling, and then the one single forex pair of the dollar yen, the US dollar versus the Japanese yen. Those are the two key inputs that move the paper price of the derivative on a daily basis. So ultimately, to answer your question, Greg, will gold go higher? Gold will go higher as long as the yen's going lower and bonds are rallying, meaning lower rates. If all of a sudden rates reverse to 2.5 or 2 3/4% of the long bond, gold's going to go down. If the dollar yen breaks its downtrend from late January, gold's going to go down. Why? Well, wait a second. There's negative rates. There's all this demand. Doesn't matter. The paper price will go down because the high frequency trading machines will sell the paper derivatives that they own simply by taking cues from interest rates and from the dollar yen. So I hopefully made that about as clear as mud because I'm trying to explain this in as short a time as possible, but that's what people need to watch. We discussed the last time we got together about copper's influence on silver, and I saw some of the comments on your YouTube channel, people saying, silver's moving up on his own, this guy's an idiot, copper didn't have anything to do with anything. Let me explain that one more time. Copper being above its 200-day moving average, as it is now, is a tailwind. It's wind in the sails of silver. When copper is falling and below its 200-day moving average, these HFT machines that buy and sell these paper derivatives provide a headwind for silver. So it doesn't mean silver can't go up if copper is going down, but on balance, think of it as a bias. Silver will be more biased to go upward if copper is moving up at the same time. Again, people have to understand what they think of as a market. Two rational adults exchanging goods at a certain price that works for both of them is not what happens here. The price is discovered for the paper derivative itself, and it's determined by electronic high-frequency trading, and all of that is done by these machines taking cues from other things that seem totally unrelated. So if it sounds like these are markets that are broken, Greg, that would probably be a safe assumption to make. And
Bill Gross just said that. Bill Gross just said that. He said the markets can't do price discovery.
No, they don't. There's a thing in the Wall Street Journal today about cattle futures and these poor guys in Nebraska that run cattle stockyards and stuff, where it used to work. An auctioneer would come. I grew up in Nebraska. I've seen this done. Auctioneer comes in, hey, 500, and some guy's auctioning off his cattle and takes the price or leaves it. But now that price is dictated to them by these high-frequency trading machines working through the exchange in Chicago. What? That doesn't have anything to do with the actual supply and demand of cows in Nebraska. But the speculators trading the paper derivative is what is allowed to set price. It is absolutely breaking everything. For my specific purposes, it's going to break the precious metals paper derivative pricing scheme as well. And we just can't wait for when that comes, because price is not going to be discovered to be $1,360 at that point.
Price discovery. I mean, how long can this? I'll ask you the Riviera question. Where you retire in the French Riviera. How long can this go on, though? I mean, what you're saying. Would you still be holding gold, and why? If you can't get any price discovery, and you don't know whether it's going to go up and down. Maybe the dollar might vault higher because Europe is in a mess, and other people are in a mess, and maybe the dollar people run to the dollar. But could the dollar actually go up and gold go up, or will the dollar go up and gold go down, or what? Tell me what's going on with the dollar-gold relationship. Why would you hold gold, and should you hold dollars?
Actually, they can go up at the same time. Most recent example was June and into early July after Brexit, where people were searching for any kind of safe haven, where actually they were getting out of euro and out of British pounds. And so the dollar and gold were going up at the same time. So they can. More specific to gold is that internal pair of the dollar versus the yen. So I don't really just look at the dollar in general as most folks do with the basket of fiat currencies like the dollar index. But it certainly can work that way. And why do I continue to hold it? And because I know I know how this is going to end. Tolstoy in War and Peace wrote that time and patience are the greatest warriors. And that's exactly right. I have time and patience on my side because I know how this ends. One day, and I'm not going to sit here and try to say it's going to happen tomorrow, but one day this unallocated, super rehypothecated system where 1 ounce of gold is pledged to 100 different owners, that is going to stop when a couple of those owners show up at once wanting their ounce and they're told they can't have it. It's not going to come from the COMEX. I'd be really surprised by that, just like I'd be just as surprised if an Italian or a German bank failed. I mean, the central banks and the banks will always work together to preserve their own. But these unallocated accounts, the worldwide, whether they're the GLD or whether they're at the Perth Mint or whether any place, so ABN AMRO, all these banks in Europe, whatever, UBS, I could rattle them all off. They tell you, oh, no, we got your gold. As long as only one person shows up at a time wanting to make a withdrawal, then everything's hunky-dory. But when everybody shows up at the Bailey Building and Loan like they did on George Bailey's wedding day, wanting their gold at once, the thing just crumbles. It's a confidence scheme, and this physical demand where negative interest rates is the greatest physical fundamental we've ever seen. This physical demand, which extracts gold from the banker's system, will eventually lead to those shortages, lead to that breakage, that lack of confidence, lead to that delivery failure, and finally the paper derivative pricing scheme will fail.
Lord Rothschild, and a lot of people hate, the Rothschilds and anybody else connected with the, the Council on Foreign Relations and the oligarchs and whatever. But Rothschild, who has, I would suspect, pretty good connections. He's out, and all these people, Gunlock, Bill Gross out with another crazy warning, Icon out with more warnings, all these big players, and Rothschild, and this is as close to a big warning as you can get from Lord Rothschild. This is the greatest experiment in monetary policy in the history of the world. And oh, by the way, their gold position is now 8%. Why are these people like Rothschild and Bill Gross and Gunlock and Carl Icahn? Why all of a sudden the last few weeks, month, 2 months, 3 weeks, and then repeated? Bill Gross had been repeatedly warning, Icahn repeatedly warning. I mean, why would Lord Rothschild care about the little people and talk about the greatest experiment in monetary policy in the history of the world? What do you think he means by that? And why are they warning?
Well, let me answer the question with my own question, Greg. If Lord Rothschild and Soros and Gunlock and Druckenmiller and Bill Gross and all these people are buying gold, they may be propping up the system by buying the GLD, but whatever. If they're advocating gold, then why is anybody that's listening to us today not buying gold themselves? I mean, if you don't own any and you're thinking, I don't know, I'd rather own a stock or keep my money in a bank at 0%. If you think you're going to wait and buy gold when this all crashes, when the whole confidence scheme fails, there's not going to be any for you to buy, at least not at a price you can afford. If they're warning you, if they're buying it, and anybody listening to us is not buying it, why? To your question, what are they warning about? Look, we've been thinking for years, ever since 2009.
Yeah.
The banks became zombies, and the only reason they continue to operate is because of political pressure on the Financial Accounting Standards Board made it so that the banks could now mark their books to maturity of the bonds rather than price, because the bonds marked to price at present are all worthless, but they're going to mature one day. All that junk from 2005, it's all going to mature one day at par, Greg. Yeah, right. So they're carrying all these worthless assets at par and appearing to be solvent. So we've been staring this in the face now for 7 years, and they've held everything together with cheap money and quantitative easing and baling wire and chewing gum. They'll probably continue to do it a little while longer, but these ultra smart people who are a lot smarter than I, they're warning that this can't go on forever. I'd take their word for it if I were listening to this.
And why do you think he called it the greatest experiment in monetary policy, the greatest experiment in monetary policy in the history of the world? I mean, because this has never been done before, and even people like him are freaking out.
Right. It's like a TF Metals report. We call it the end of the great Keynesian experiment, that you could just create more and more debt and load debt on top of debt and borrow more debt to pay back the old debt. And okay, that's fine. I guess it's gotten us this far, but that just can't go on indefinitely. I mean, my grandmother always told me, make sure you at least pay the monthly charges on your credit card, because the compounding interest will kill you if you don't keep up with it. And we're not keeping up with it on a grand scale. And eventually it goes parabolic. You can't print it fast enough. And when it collapses and there's a reset, it's going to be a calamity. And I think the world will return to some type of sound money, maybe not a classical gold standard, but at least some type of reserve currency that has an anchor rather than a printing press. And that anchor will be gold or some collection of hard assets. And that's how I will preserve what I have today and move it into the next paradigm. But it's definitely coming, simply because it can't go on forever. But what people get frustrated with, and I'm certainly keenly aware of, are these folks out there that say the end's going to happen next Tuesday. Look, just use this time to keep preparing for this eventuality. Not so worried about whether it's going to be a date certain in the future.
Oh, and I know you famously said you can only predict the end of the world one time, which is great. But these guys, all in this chorus of warning, aren't they? Don't you just smell we're getting ready to hit that Roadrunner moment, that Wile E. Coyote moment, right at the cliff? Aren't you getting the idea that these guys are warning because we're getting closer, even though it's maybe not next Tuesday?
Maybe. I mean, I never really trust anybody, because you never know if they're talking their book. Who isn't to say that somebody that should, think back in the .com days, all those pukes that show up on CNBC and talk about how Pets.com and Lucent were going to the moon at the same time their bank, their employer, was unloading all their Pets.com and their Lucent. So you always gotta take some stuff with a grain of salt. You got to kind of make sure you're dealing with somebody that is being upfront and honest. But in the bigger picture, fundamentally, they're correct for all the reasons we just talked about a couple minutes ago. Look, this is coming. I know I've been saying that for 5 years, but just the fact that it hasn't happened yet doesn't mean it's not going to happen. And here's one other thing. I just was, last week, I do a thing for my subscribers. We do a weekly webinar where I bring in somebody way smarter than I do to field questions from my subscribers. And this week was Alistair McLeod of Gold Money, who's just a brilliant economist. Most folks listening to us probably know who he is. And he's been watching the LIBOR rate and paying very close attention, especially in the last couple of months. And it's been skyrocketing, where the Fed funds rate is still down here at 25 basis points. And money market rates are at 0, and we got negative rates all over Europe, even at the retail level. LIBOR now, 3-month LIBOR is almost 1%. So there is a demand for liquidity, and what this is telling Alistair is some of these dollars and euro that have been, in a sense, quarantined as the central banks have just simply created cash and transferred it to the banks in exchange for worthless securities. And now these banks have all built up these trillions in excess reserves, essentially quarantining some of that money and keeping us away from the hyperinflation that so many of us feared would be coming right away in 2010 or 11. Well, now finally, this LIBOR may be a sign that that money is starting to slush out, because as a bank, the Fed will pay you 50 basis points or whatever it is on your excess reserves. But hell, if you can get 100 basis points by loaning it out to somebody in search of liquidity through LIBOR, why not take it? And all of a sudden that money gets unquarantined. And we may finally, in late this year and in 17, begin seeing some really rampant, not necessarily hyperinflation, but serious inflation like we saw in the 70s. And anybody, at least as old as you and I, can remember the 1970s for being stagflation, whip inflation now buttons, and a gold price that went from $45 to $845. The luxury we don't have now is what Paul Volcker had in 1979-80 to raise rates 20% and soak up all those dollars. That's not going to happen this time. But if we do get now into an inflationary environment again, on top of everything else, negative rates, all the other reasons to own gold, let's put it all back together. Even though we talk about paper prices, the physical demand will continue to drive gold and silver higher and higher, regardless of what the COT structure looks like and all these little scaredy cat things that come out every week from people trying to sell their newsletter. It's a good time to own gold. It's a good time to continue to accumulate gold, if anything, for the reasons that we've spent time discussing today.
One final question, just quickly. SDR in September, special drawing rights currency. Jim Rickards has called it the beginning of the end of the petrodollar, and then fireworks at the end of the month. And people are worried about the beginning of October. Or just what's your view on the SDR and the yuan being in the IMF basket of currency? And that just what do you think? I mean, is this a pivotal time in the market, September, October this year?
It's not going to catch anybody by surprise, right?
That's right.
And usually it's things that catch folks by surprise that is what really moves markets and causes disorderly market action. It's a big deal. It's an internationalization of the yuan, which is a process that's been going on for about 10 years. The Shanghai Gold Exchange, all the stuff they've done in London, issuance of renminbi-backed or denominated bonds, all of this stuff is an internationalization of the Chinese currency. And as that structure gets put into place, it will allow them to at least rival, if not challenge directly, this U.S. hegemony of a world reserve currency. And if the U.S. collapses again, the reason why the Chinese are rushing to put this in place is because everything collapsed in 2008 and they were sinking on the ship with everybody else. And I think the Chinese, who think in terms of decades and centuries, sat back and went, oh, crap. We're not going to let that happen again. We can see how they're holding this together. The next time it fails, we're going to offer the world an alternative. And this inclusion of the SDR is a part of internationalizing their currency so that there is an alternative next time. Is it a big deal in September? Is it? Man, I'd sure be surprised if it was. And the last thing I'm going to do, as we talked about before, is get on the record with date and time, because if you go around predicting the end of the world, you're only going to be right once, as you said earlier. And I'm sure September will be interesting, but if anything, it's just a step in that direction, ultimately challenging the U.S. The U.S. has had this ability for 70 years. They're not going to have it forever. And that's what they're accomplishing by that inclusion in the SDR is part of that deal.
At some point, we're going to hear that snap, I mean, it's going to be over. Anyway, get ready and stay ready, I guess sounds like the message you're giving. Get ready and stay ready? Yes,
that's a good way to put it, my friend.
All right, Craig Hemke, tfmetalsreport.com. You have free information on the site. You also have, 40 cents a day to become a subscriber. Relatively inexpensive. There's a big message board there. A lot of people talking on there. You have guests on. Anyway, Craig Hemke, thanks for joining us today on usawatchdog.com.
Greg, always a pleasure. All the best to everybody there.